basically some cross currents going on in the market right now. And these cross currents in the market right now that are causing the choppy action are basically the fear of rising rates, which is hurting growth stocks. And then on the positive front, you have this stimulus coming in and the potential for reopening of the economy and the sort of reflation trade. And these two things are battling with each other, and that's why you see the S&P, grinding around. You see the Nasdaq somewhat weaker. We see some sectors that we've discussed in past videos, such as financials, energy, etc., being strong, even in the face of this environment. We see the Dow being relatively strong, things like that. So the best term for this, or a good term for this, is cross currents, as that's essentially what's happening. And one of the most important ones is the relationship between rates, as shown in the benchmark 10-year that you see at the top of the screen, and growth stocks. As we've discussed in past videos, these growth stocks are not as attractive in a rising rate environment. You can go back to past videos for an explanation on that. So the two charts that you're seeing here in front of you are the TNX on top, which is the yield on the 10-year note, and the QQQ on the bottom, which we can use as a benchmark for all things tech and all things growth, okay? I've drawn two lines here specifically in the chart, and I've purposely moved the charts exactly so they'll be lined up. And it's exactly on these two dates, the first one being February 15th here. And the reason I chose this date is this is the exact time where the QQQ started basically moving down, right? It was the first time also, as you can see, it corresponded perfectly with rates going up. And the second line is the exact date when the yield on the 10-year crossed 1.5. This was just basically known as a major line in the sand. Everybody was kind of waiting for this cross over 1.5, and the sky is falling, rates are going, rates are over 1.5, and you can see that the Qs were relatively weak that day as well. But here's where the charts gets very interesting, and why I think that this chart supports the theory that I have been saying for some time now. You've heard me discuss this in the videos, and those of you who are subscribers to my weekly options advisory know that I discuss this at length in private webinars, live sessions, and What's Peter Thinking audio messages a lot, that my theory is that the market is gradually, and it's already underway, as I'm about to show you on these charts, the market is gradually forgetting about this, for lack of a better word. Maybe forgetting isn't the right word, but it's this constant shift to the next shiny object. I've used that terminology before, and I think it's extremely apt. The market basically has correlations. Those correlations stay very tight for some time, and then they just break on a dime, and everybody kind of forgets about it very quickly. If you think back, if you've been a trader investor for some time, you know that there have been many of these mini crises, so to speak, where the market was just focused on, Greece, or the price of oil, or what the dollar is doing, or, et cetera. And the market tends to move lockstep or exactly opposite what that's doing. And that's a thing for a while until it's not a thing. And then when it's not a thing, it's very interesting to me how quickly traders and investors forget about that thing because they all start focusing on the next thing. So I'm of the opinion that this slow sort of forgetting process is underway. And I think that these two charts illustrate that very well. In the chart of the 10-year yield above, notice that the trajectory to this moment is still straight up. It hasn't stopped. As a matter of fact, yields went as high as 1.754%, as you can see in the picture. But notice the trajectory of the Qs during that same time. You can't say that it's straight down, because notice that the Qs really made a swing low here, and that's when yields were here, when yields were right around 1.5-ish. And since then, like I said, yields have continued to travel higher, and so has the Qs. Notice that tech has actually traveled higher. Now, we were weak these last couple of days of the week, but if you look at it in terms of where we are, even just using simple moving averages, I've purposely simplified these two charts down to just one moving average, which is just the 20. Notice how rates are trending so high above the 20, and yet here you pull in, here you almost touch, here you cross, or just by a little you touch, here you cross the 20 to the upside, and here you test the 20 again. So it's interesting to note that on a simple 20-period moving average, the QQQ is actually just kind of riding underneath it and even a little bit above it earlier this week, while rates continue to drive higher. So it appears to me that this correlation between fear in tech stocks and these rising rates is slowly breaking. And at some point, like I said, I think what's going to happen is we will just forget about it. Now, how high do rates have to go for bonds to sort of find some equilibrium where this won't matter as much anymore? I don't know the answer to that, but I've read up on it a little bit, and some people think that number is 2%. That's just a number that gets thrown around. We shall see. Maybe 2% will be the next area where the market, throws a little bit of a hissy fit. But that doesn't really make sense to me that there would be any sort of adverse reaction at a 2% rate, because there hasn't been more of an adverse reaction when we went from 1.2 to 1.7 here. And the market is always a discounting mechanism, as we know. And since the trajectory of the bonds is slowly up, you would think that the market would already be pricing that in, thinking, aha, we should be much lower because yields are going to be 2% very, very soon. But it just basically hasn't happened, all right? And I'm not going to go into the charts in this particular video, but in your spare time, look at some of the Fangman plus T and look at some of the patterns, especially, for instance, Facebook, which had a little bit of news on the Instagram front on Friday. And I'm just looking over there at my Fangman plus T and was actually up 4% on Friday, which is huge. Amazon was up 1.5. Only Apple, only Apple and Microsoft were actually red on Friday. And yet, what did yields do? Yields had a green day, correct? I mean, they opened here and they closed higher. It was clearly a green candle, and notice that the close of where the 10-year closed on Friday was actually very close to the open close of where they were the highest recently, in the most recent swing high, all right? So these two charts are very, very important. And I would urge investors to keep them, close by at all times. And if you can, if you've got the real estate, so to speak, put them on your charts this way. Basically, put the yield on top and put the QQQ on the bottom. And before I get off this section, I'll just leave you with switching this to XLK, which is really same thing, just as a proxy for tech, or maybe a little bit more of a proxy for tech, I should say, than the QQQ, which is a little bit broader. And it's really the exact same thing. It's obvious that XLK is going to hew very close to QQQ, but I thought it was interesting to look at this very, very tech-heavy ETF and notice that the inflection points are all the same. It's the same exact turning points when you line it up with these specific time periods, where this was the swing high in XLK where it started to come off. And again, as far as the 20 MA is concerned, right, here, big cross here to the other side, and just underneath. So it's really just all the same. So either way you want to look at it, you can look at QQQ or you can XLK. But over the next couple of weeks or so, try and have these two charts up at the same time. And also remember that earnings reports for all of these stocks, which are very, very important, are going to start coming upon us in like mid-April. So there is potential that this malaise continues for some time, but it's important to note that what's going on right now, and you'll see that a little bit more as I get into some other charts in this video, is it is more of just a malaise than any all-out stronger selling. Chart number 2 is a chart of the dollar index. This one doesn't have as strong of a correlation with equities, but historically there are times where the dollar does have a very strong correlation with equities. You can almost go like 1-to-1, like basically you can trade ES against the euro or whatever. And this isn't really one of those times, but I thought that it was worth mentioning in the context of these three charts of this discussion. And I specifically put the vertical line here on the February 25th day, which is the exact time when the 10-year moved up over 1.5. And you can see that caused a big move up in the dollar that sort of set this large move into motion. And it peaked right here at March 9th. And I think this is kind of noteworthy, only that on March 9th, if we go back to our TNX chart, right, this right here is March 9th. Down in here, oops, I got to get it right. There we go. March 9th is actually here when yields were at 1.5. And again, what has happened since then? Boom, we've exploded all the way up to 1.7. But at the same time, the dollar index is no longer participating in that move. It has just started to back off. Now, obviously, a lot more than just rates bears on the dollar. But just keep in mind that there's a general rule of thumb that equities tend to perform better in a lower dollar environment as the dollar is getting hurt for a number of reasons. Obviously, stocks are paper assets that are denominated in dollars, so that would make them go up the same way that it inflates the price of commodities, right? A weaker dollar is inflationary, and I've always said that inflation is good for equities. That's a fact, just in the same way that it's good for commodity prices. And, on a very simple level, we know that it is positive for U.S. exports, right? So obviously it is accretive somewhat to the bottom line of a lot of our companies that are multinational. So as the dollar has come off of recent swing highs and started to, quote unquote, calm down a little bit, I feel that that's also a sign that this is just sort of a malaise, that sort of this too will pass, as I was saying, that this is yet another thing that fits in with the TNX versus QQQ that the market will eventually forget about and, like I said, move on to the next shiny object. Okay, the last chart number 3, which is kind of a two-parter because I'll do a NYSE and a NASDAQ. This is the new highs minus new lows. And as you can see here, this is obviously the time period that we need to look at, which is the time from the late February where the yields started to rise. And, basically not a lot is happening here. Basically, this would be a lot more negative. We'd have more of a situation like this where we would see a lot more new highs minus new lows. It would be a lot lower, I should say. This relationship, new highs minus new lows, this net number would be a lot lower if things were worse. Notice that even just recently, as recent as Thursday, you had a big number here, the upside plus 300. This is on the New York Stock Exchange. And if I move this over to the NASDAQ, which was the NAHL, I just put that like that. Again, same thing, right? You only had this situation here on March 4th where you had a very negative relationship, between new highs, new lows. So obviously you had many more new lows. And mind you, these are 52-week lows, so you understand how this works. This is any stock that has made a new 52-week high and any stock that has made a new 52-week low, and is the net of them on the entire NASDAQ exchange. And notice that, again, not all that much is happening here. When did the worst of it happen? Here, February 26th, and here on March 4th. And again, if we go back to our chart, and let's just use QQQ, and let's just mouse over here. What is February 26th? Well, it's this day right here. And I'll just draw the arrow. That's February 26th, okay? So you can see price didn't even breach those 2 days, and yet you had new lows registering. And when's March 4th? March 4th is actually this day. This is March 4th. And as you can see, soon after that, what happens, market bottoms out, and then that new high minus new low indicator is looking okay, right? It's looking a lot more calm, and you don't see that activity anymore where you have these where you have negative. So the way you want to look at this basically is that as the NASDAQ has been moving up since these swing lows, the relationship between new highs minus new lows has basically righted itself. It has basically come into a more normalized, normal state. As the market is grinding slowly higher, you notice that the number is generally positive. Always stocks are hitting new 52-week highs somewhere across the entire exchange, and the lows came in when we would expect them to come, but more importantly, we're not seeing divergence. This chart would be alarming if the price of the QQQ, which is a more narrow measure of the market, was grinding upwards, as we know it is over this period since this low, and these new highs minus new lows were registering new lows. But that's not happening, okay? That's the type of divergence you want to be looking for. That's basically using market internals to your benefit, where you're looking at something on your chart that's more narrow and you're looking at something that's more broad underneath it. This is why the market internals that we look at For the ES, for instance, on the quad, we're looking at the breadth relationship of up volume, down volume on the entire New York Stock Exchange. We're looking at the advancers minus decliners on the entire New York Stock Exchange to give us this sort of broader overview of what's really happening with lots of stocks on the entire exchange level, which would then tell us that the smaller group of stocks of S&P 500, and then by design, of course, the ES, which follows it, right, should react eventually because these underpinnings are like this. But again, when we look at these charts, we're not seeing these negative underpinnings at all as the market has been grinding higher a little bit recently. So again, to me, this is yet another example that, you know, again, this too will pass, and basically we have a situation where these tech stocks are more biding their time right now rather than, you know, selling off in a very, you know, violent manner.